In Chapter 2, we're going to look at asset classes and financial instruments. Briefly, how you define an asset class. So we have three primary categories, if you will, of asset classes: fixed income, equity, and derivatives. And of course, we're going to discuss the components of each one of those classes. So under fixed income, we have money markets and we have capital markets. In general, money markets refers to short-term assets. Capital markets are long-term assets. So what is the money market? It's obviously a sector of fixed income, very short-term. By definition, all of these things are debt instruments, and they are very liquid. What does liquidity mean? Well, a definition of liquidity refers to how quickly you can convert an asset to cash and maintain its value. If you can turn an asset into cash very quickly, but it loses half or more of its value, that certainly isn't something that would be called liquid. These are very low risk. They typically have fairly large denominations. So what kinds of things are there? Treasury bills, obviously issued by the United States government. They're very liquid. Certificates of deposit, not the same ones that you and I can buy. These are what are referred to as negotiable CDs. They can be traded. Commercial paper is short-term, unsecured corporate debt. So it's debt that essentially corporations sign their names for to get the money. Some other things that aren't quite as popular: bankers' acceptances help us with foreign trade. Euro deposits or euro dollars are deposits that are held outside the United States. Repos and reverses. These are short-term borrowings, typically of Treasury securities. And of course, the federal funds, I'm sure you've heard of that. This is actually the storage of required balances at the Federal Reserve Bank. So this is where banks can borrow and lend between themselves, and it's also a source of them to get money in order to provide that to its creditors, its investors. What about pricing, right? Most of these securities are sold at a discount. That is, they're sold at a price below their principal value. The ask price is the price you pay to buy a security. So since you're buying this, think about retail. This is the retail price. The bid price is the wholesale price. That's the price that you get when you sell the security. So it's the wholesale price. This is what you get when you give the security to the broker. Ask price is what you pay when you get it back from the broker. So the bid-ask spread represents the profit to the brokerage house on trades. Money market securities are not totally free of default risk. Treasury securities are default free, but all of the others do have some risk. Now there is a marker or an indicator that's called the TED spread. This is the relationship between the interbank loan rates and T-bill rates. What happens is as this rate increases, it could be a sign of financial crisis in the economy. So we have a picture here of the TED spread, and as you can see, where there were crises over the last 40 years or so, we had spikes in this TED rate. Currently, we can see that from 14, 15, 16, the TED spread is rather low, which is indicative of an economy that is currently not in great stress. What about capital markets then? What can we talk about the capital market and bonds? Well, obviously, there are a lot more of these to talk about, even though they fall into some basic categories. It's a subsector, the capital market, again, subsector of fixed income. They're long-term, they're liquid. relatively low risk, but not as low risk as the money market securities. We have Treasury notes and bonds, typically a par value of 1,000. They pay interest paid semi-annually, and essentially their quotes are at a percentage of par. We'll talk about prices here in a little bit. Additionally, we have something called TIPS. They are inflation protected Treasury bonds. So these bonds offset any impact that inflation might have on a Treasury security. We can get bonds from federal agencies. There are a variety of federal agencies that are given the right to borrow funds. These are not default free, but there is a moral obligation of the government to cover them. International bonds, certainly we can have Euro bonds, Yankee bonds. We'll talk about these a little bit more detail when we get to the bond week. Municipal bonds issued by state and local governments. One of the things that's interesting about state and local government debt is this debt interest is exempt from federal income taxes. So you will pay state and local taxes usually, but you won't pay federal taxes. Again, they're not default free, and they're not backed by the federal government. So the obligation of payment is dependent on the type of bond that it is. A general obligation bond is backed by the taxing power of the entity. A revenue bond is backed by the project of which was created with this debt. So like a turnpike, right? The payment for the turnpike is ultimately paid for through the tolls of the turnpike. So let's think a little bit about taxes, right? If you have a corporate bond, you would have to pay taxes at the federal and state level. A federal bond, right? A government bond, United States Treasury bond, you would pay federal taxes, but you wouldn't pay state and local taxes. For a municipal bond, again, you would pay federal taxes, you would pay state and local taxes, but you wouldn't pay federal taxes. So we need a way of comparing these types of debt. So if we assume that the debt is of similar risk things should have relatively close rates of return. How do you pick between those different securities? So we would like to have a return, right, that compensates us for taxes that might ultimately have to be paid. So let's think about an example. I think it's better to show an example. R sub M here is the return on a municipal bond. So here we have a 3% municipal bond yield. So that if you buy that's what you'd earn. We also have a person that's in the 20% tax bracket. So if this person had a corporate bond, what rate of return on the corporate bond would get you more money than the tax-exempt bond? Again, this follows kind of the strategy of there's no such thing as a free lunch. All right? Being able to have the ability of not paying taxes is a benefit, so it's going to cost you something. So in this case, the tax-exempt yield is 3.75%. Take the 3% divided by 1 minus the tax bracket. So if you were in a 20% tax bracket, a corporate bond would have to yield more than 3.75% for it to be more attractive than this 3% bond. What if you were in a 40% tax bracket? You'd need to have a corporate bond of at least 5%. What about a 5% yield on a marginal thing? Then obviously what you need more corporate return to equal the municipal return, because we're interested in after taxes. So this 3.75% before taxes is equal to 3% after taxes. So again, we want to be able to make these comparisons of different debt. Corporate debt, certainly we're familiar, you should be familiar that corporations issue debt. Usually they're issued possibly by private firms, sometimes by public firms, right? But they pay semi-annual rate, larger default risk. There are different options or conversions of these things that we can buy. You think in general about, if you think about different kinds of debt, we have debt that's secured or unsecured. Secured means it has collateral. Unsecured means it does not have collateral. A debenture is the name of an unsecured corporate bond. Subordination. When bonds are issued, how do we pay them off? For instance, what if a company goes bankrupt? Who gets paid first? The first people that get paid are the secured holders, those assets that are collateral are sold and then that money is used to pay off that debt. But everything else is referred to as subordinated. It's sometimes also referred to as junior debt. We can have callable bonds that allow for refinancing. We can have convertible bonds that can be converted into stock, or you can change your position from being a lender to an owner. Again, these are just terms. When we get to a later chapter, we'll discuss this in more detail when we talk in the bond sections. We also have something referred to mortgage-backed securities. We briefly talked about them earlier. They represent ownership in a mortgage pool. Most of these have been issued by Fannie Mae and Freddie Mac. We also have some that are issued by an agency called Ginnie Mae. So again, these are what are referred to as pass-through securities. Need an S there. Pass-through securities. And we talked about these again in the last chapter. So let's continue on. So I kind of conclude this. Traditionally, these, if you remember our discussion in the earlier chapter, were all written on what we refer to as conforming mortgages. Later, they started issuing these on what was referred to as subprime mortgages, which made them all riskier. Fannie and Freddie were also allowed and even encouraged to buy these subprime mortgages. And again, when we talked about the crash of the financial industry, that is part of the whole process that created the challenges with respect to the mortgage market in our economy. So that's the end of part one. We're going to skip to part two here in just a second.